recent US stock market has been surging all the way. Since April, many Wall Street analysts have begun to express concerns. They argue that US stocks are now overvalued and about to experience a sharp decline. But will the stock market really crash heavily? Hello everyone, this is Jason Tang, an analyst at TradingKey. Today, I will clearly tell you, do not worry. A sharp drop or crash is almost impossible in the next 12 months. In fact, before every stock market crash, the market shows corresponding signs. The first sign is the Federal Reserve's continued interest rate hikes. When interest rates rise, borrowing becomes more costly. People can no longer afford to take out more loans. In such cases, how can business increase investment? How can households increase spending? As for stocks, they will naturally underperform. The second sign is an economic recession. If the economy is in a recession, how can the stock market possibly performing well? However, there is one point I need to emphasize here. Hard economic data have a lag. That makes such data not very meaningful. Therefore, leading indicators, especially the US Treasury yield curve, become particularly important. So, the third sign is what the yield curve looks like. If this curve inverts, it means borrowing short-term money becomes more expensive than borrowing long-term money. This indicates that investors are fearing an economic crisis and heavily buying safe assets, namely long-term US Treasury bond. This massive buying pressure pushes long-term yield lower than short-term ones. To put it into a simple way, an inverted US Treasury yield curve suggests the economy is about to slow down or even enter a recession, and the stock market will also be in danger. The fourth sign is high valuation and high leverage. In my opinion, no matter the reason, if something keeps getting more and more expensive and the higher its price goes, the more people rush to buy it, even borrowing money to buy it when they can't afford it outright. Then something must be wrong. Academically, this is called a bubble. Among these four signs, I believe the most crucial one is the first, the Fed Reserve interest rate hikes. Let me draw an analogy here. High valuations and high leverage are like firewood. Without a spark, firewood does not catch fire on its own. And the Federal Reserve's interest rate hikes are like the spark. Only when firewood and the spark meet, there will be a market crash. Now let's turn to history lessons to see the tale of firewood and the spark. History 1 is the Roaring 20s. In the 1920s, everyone was borrowing money to rush into the stock market. Then by 1928, inflation emerged, and the Federal Reserve began raising interest rates. There was not just one single rate hike, but a series of continued hikes. By October of the following year, on one Tuesday, a spark meeting firewood caused a fire. The stock market collapsed entirely, and the decade-long Great Depression began. History 2. In the later 1980s, people began to use computers for automated stock trading. When stock price fell, computers would automatically sell stocks to stop losses. However, problems appeared when everyone started using this method for trading. When stock price fell below a certain levels, there were nothing but sales orders in everywhere. What made it worse was that the Federal Reserve had just entered an interest rate hike circle to curb inflation at that time. With these two factors getting together, Black Monday arrived, triggering a stock market crash. On that single day alone, the Dow Jones plummeted by 22%. History 3. This time it's different. This phrase was so popular in the later 1990s. This period was called the New Age of the Internet. Back then, it didn't matter whether a listed company could actually make money. As long as it claimed to be an internet company, its stock price would soar. It was a classical bubble. And in the end, it was still the Federal Reserve's interest rate hikes that pricked the bubble. The Fed began raising rates in 1999. Having gone through 2 previous stock market crashes, investors should have learned their lessons this time, right? But as it turned out, no, they didn't. The reason, once again, was the familiar phrase. This time, it's different. However, the outcome was that they are all the same. In 2000, due to continued interest rate hikes, a stock market crash occurred. The Nasdaq plummeted 77% from its peak, and most internet companies went bankrupt along with it. The last story is 2008 subprime crisis. Of course, since the crisis later became so severe, it was renamed the global financial crisis. After the dot-com crisis in 2000, the Federal Reserve switched to rescue the market. Instead of raising interest rates, it started cutting them. As rates keep falling, people realized borrowing money had become so cheap. As a result, housing prices soared, real estate-related financial product prices soared, and stock prices soared. And then the Federal Reserve raised the interest rate again this time. Once the rate hike cycle continued, subprime mortgages become hard to repay. The result is people started selling their house. Housing prices collapsed. Financial chains broke and the stock market crashed. After reading these 4 stories, I conclude a principle. Federal Reserve rate hikes do not always cause market crashes, but every major crash has been closely tied to the Fed's sustained tightening of monetary policy. Today, let's discuss why there is no significant risk in the current US stock market. Although US inflation has shown signs of picking up recently, overall it's still manageable. That's why the Federal Reserve will almost certainly restart interest rate cuts in September. Based on the theory I mentioned, no rate hikes means there is no spark, and there is no way for dry firewood to be ignited. But now we are talking about rate cuts. In other words, there is not just no spark, there is even water to reduce potential risks. So, how likely is a stock market crash then? Beyond the Federal Reserve's monetary policy, when it comes to economic growth, the US situation shows a mixed picture. GDP performed poorly in the first quarter but rebounded in the second quarter. Consumption among low-income households is struggling, but consumption growth among middle and high-income groups remain resilient. Manufacturing is underperforming, but the service sector is still doing quite well. Non-farm payroll data are disappointing, but the unemployment is still low. This mixed picture does not mean the US economy will have completely bright future ahead, but it's unlikely to slip into a recession either. Therefore, a financial market crisis is also equally unlikely. Regarding to the US Treasury yield curve, I think the current shape of this curve looks okay, except for a slight inversion between the 1-year and 3-year. The segments from the 3-year to 30-year are all on a positive slope. So I don't see any sign of a stock market crash from this yield curve. All in all, I still stand by my statement. Firewood will not catch fire without a spark. That means high valuations and high leverage alone, without factors like Federal Reserve rate hikes, an economic recession, or a normalization of the yield curve, will not trigger a stock market crash, at least in the short term. Therefore, I remain bullish on US stocks over the next 12 months. Friends, do you have any opinions or different views to share? Feel free to leave comments below. If you would like to learn more about analysis of the broad market, sector, and individual stocks, please follow TradingKey. We will continue to bring you exclusive in-depth content. Thank you all for watching and see you next time.